just like in your own business, as a company owner or entrepreneur or family-owned business, you have a business process in order to create your product or service. Same thing in mergers and acquisitions. Mergers and acquisitions is an industry. Mergers and acquisitions have professionals that bring a company through the process of either preparing itself for sale, selling the company, and then closing the transaction. First step, of course, is preparing your company for sale or for investment. You'll be surprised at how many companies go right to market and they're not really prepared for sale. And that could cover a whole range of things like getting your books in order, hiring the right experts in it, getting your structures, your legal structures in order, just really preparing your company for investment or sale. So congratulations, now you have someone interested in your business. After you prepare the company for sale, they want to give you an offer for that, and you expect what's called a letter of intent or a term sheet. Much of that term sheet is not legally binding, but a buyer or investor in your business would perhaps want a couple of things that are binding from a legal perspective. One of them being confidentiality, the terms of the offer and terms of the transaction. Sometimes you as an owner don't want the market to know that you're up for sale, so you may want to keep all of that confidential. Second thing in a letter of intent is an exclusivity. Pretty much is for the benefit of the buyer or the investor in the business. They were going to be spending a lot of money looking into your business. They want to make sure that other people, other financial investors or other strategic investors trying to sell your business to them while they're spending a lot of money in the due diligence process. After the letter of intent stage, you have it executed or signed by both parties. Then it goes into a due diligence process. It's a way for the buyer to really get to understand your business, get to confirm everything you've said during the process and understanding your company is in order. You know, there's a number of things that can happen that could perhaps change the deal a little bit depending on what was found. But if you did a great job or a decent job of preparing your company for sale, there should be no surprises. This is also an opportunity for the buyer to understand how to grow your business, which employees could be managers in the business. So this is a great time for the buyer to do diligence, and also as a seller or an owner of a family-owned business, this is a way for you to do due diligence on the potential buyer, especially if you have a role going forward. And so do use the due diligence time to figure out whether and how you work. After a confirmatory due diligence is completed, that usually is the time when documentation or the purchase and sale agreement is going to be drafted and negotiated. So you negotiate through that, you figure out the terms, the indemnifications. If you have a good deal lawyer, they're going to be looking at and making sure you're indemnified. From documentation of the purchase and sale agreement, you got to figure out whether it's an asset sale or a stock sale. Usually you figure that during the letter of intent, and that's enacted upon. And then you negotiate the management contracts, especially if you're staying on, consulting arrangements. So all of that is negotiated. After all of that is put together, everything is A-OK. The buyer has all the money put together. Perhaps there was a financing contingent in the letter of intent, which basically means that the buyer has to make sure that they can raise the money from a debt perspective into the company, and that also has to deal with financial due diligence. A good accountant do some financial due diligence in there. And so when all of that is completed, then you close the transaction, and then you go into the integration of the company. If you're remaining with the company, it's a good way to figure out whether you need additional management, how you integrate into the various aspects of the new company or the new organization. So from preparing your company sale, having a letter of intent, conducting confirmatory due diligence, preparing the documentation and the management agreements and closing the sale. That is the process of an M&A transaction.